Good afternoon, ladies and gentlemen. It is the first week of February, February 5th of 2024. Glad everyone could join us. We had a busy week last week. The Federal Reserve came out with their comments. We saw a ton of volatility as it related to the overall market, in particular around those Federal Reserve comments. But I think more importantly was we walked into that week with a very, very overbought stock market. And that tends to happen when stocks are overbought. Accidents just happen. It's markets are going to check back every once in a while. And if you tuned into our weekly updates the week before that, stocks were overbought. And when stocks are overbought, it's a symptom of long-term strength. Bull markets spend most of their time in an overbought condition. But when you're at the upper echelons of that overbought condition, things tend to get overheated and you happen to get pullbacks. You get exposed to headlines, as we call that headline risk. But long term, nothing's really changed. And that's going to be our big message this week. So I'll go ahead, share my screen like I do every single week. And naturally speaking, the title of this week's presentation is Do Stocks Need to Chill? And why is that? Realistically, the short-term conditions continue to appear overbought, but underneath the surface, market internals are strong, and we're seeing very, very long-term positive trends across many stocks and sectors in the overall market. So we'll start off this week with a stock market technical review. We'll go through, why did stocks sell off on those Jerome Powell comments? And then lastly, we'll wrap things up with a credit market health check. So as it relates to the overall S&P 500, we can see here that we had our first internal distribution day. In other words, there were more than 5-to-1 down stocks versus up stocks. And we saw a negative 6.7 to 1. That was, of course, on Wednesday there. And, we could try to make a lot out of this, or we could simply say, you know what? Stocks were really overbought. Now, what caused that? Of course, Jerome Powell came out and said that, we're going to have rate cuts, but we're not going to start in March. And we may not have those 6 or 7 rate cuts that everyone's looking for. And if you remember, that's what we've been sort of pounding the drum on for the last few months is that, there'll be some rate cuts. We just don't understand why people are thinking there's going to be 6 or 7. Unless the economy itself is tanking and the Federal Reserve is responding to an emergency or to a recession or to rapidly slowing growth. If the economy is staying strong and employment is strong, which we saw with that Friday jobs report, why waste ammunition to respond to an emergency by cutting rates when the economy is actually absorbing high rates? It's actually not bad for the economy either to not have cheap money sloshing around. So in our opinion, the Federal Reserve is doing the right thing by not just cutting rates for the sake of cutting rates. And when the time becomes necessary to do so, when inflation falls back and we need to get growth goosed up a little bit, then we'll be able to cut rates and get that going. But overall, markets were overbought. This is a healthy correction in our opinion. Again, until more evidence says otherwise. And price action is important. And we've seen that in the past, right? So if we look simply at the ISM manufacturing index, so below 50 means you're in a manufacturing recession. Above 50 means you're in a expansion. We've had now 15 straight months of the ISM below 50. And a lot of the bear recessionistas out there will continue to point to the ISM, the ISM, the ISM. Well, if you continue to pay attention to that ISM, you would have been short stocks the entire time while the market runs up. What the market has sniffed out is, there's some manufacturing weak spots, right? But they're weak spots. The rails are breaking out, right? You have industrials as a sector breaking out and hitting 52-week highs. So there might be some spots within manufacturing that are weak, but there's also a very big chunk of manufacturing that's actually quite resilient, and you're seeing it played out in earnings for individual companies. The one area that I would say is a little concerning, just short term from a trading perspective, is overall investor sentiment. So we can see here investor sentiment remains quite elevated, not quite to that 2 standard deviation danger zone yet, pretty close. So again, we look at where stocks are relative to their 200-day moving average. We look at where investor sentiment is and how close it is to that 2 standard deviation reading, as we see here on the chart over here. Again, things are short-term overbought, and you can expect some negative volatility days as a result of that. I wouldn't look too much into it. The one area that we do think is of more cyclical plus secular risk is technology. And I know that's not a popular view, but that's okay. That's what we're paid here to do. And technology remains incredibly overvalued in our opinion. It is very overbought in our opinion. And we would also say that the amount of sector ETF flows going into technology is also very indicative of extreme sentiment that is taking place in the technology sector, right? So it's that old adage of you travel too close to the sun, you're going to get burned. We think technology stocks are traveling way, way, way too close to the sun. We're focused on less crowded areas with attractive prices that have identifiable catalysts that can unlock value over the next 6 to 12 months. And we're going to stay disciplined in that area. We're not going to repeat those 2021 mistakes, early 2022 errors. We're going to stay focused to our process. And where we see value right now, energy, industrials, financials, those are the areas of the market that we see long-term value, good dividend growth, and very solid earnings growth at very heavily discounted prices versus the market and their other sector peers. And we're already seeing some evidence. So if you get past that Magnificent Seven, right? Those Magnificent Seven stocks, certainly Meta up 20% on Friday. I mean, if there is one stock we think is cheap within the Mag 7 group, it is Facebook. But outside of that, your average high-priced technology stock has actually struggled this year. So if we look at ARK Funds, which is that collection of high-price, high-multiple tech stocks in the market, ARK Funds are down 13.82%. That's nothing to sneeze at, right? And so underneath the surface, underneath that real nice golden layer of the Mag 7, you're having a lot of stocks breaking down. And so we want to pay attention to that. You can only put so much money in the Mag 7. Every other fund out there has Mag 7 exposure. We're gonna steer clear of that for now. The other area we saw with some headline risk this week was there was a bank up there in New York State that had some commercial property write-offs that caused a sell-off in the regional bank sector. We do have an overweight position in regional banks. But what we saw there was a couple of loans from that one specific bank, which we do not own. And overall, we're not really seeing any real concern in the bond market. So when we look at implied credit risk in the high yield market, implied credit risk is actually plummeting to near 52-week lows. And that's actually a symptom of health. We usually like to look at the CDS market, the credit default swap market, that measures implied credit risk in the bond market, and look for, is there any inkling whatsoever that bond traders are sniffing out some danger? And we're just not seeing that right now at this moment. Other big headline was that the Saudis are going to slash oil spending. Saudi Aramco, which is basically the private company version of the Saudi government, and they're the ones that take care of all the drilling, the production, transportation of all of Saudi Arabia's oil. They did a U-turn and announced that they're going to do dramatic cuts in terms of capacity spending, capacity expansion spending. So they're taking back capacity out of the market. And you saw oil service names sell off quite dramatically. I think that was on like Tuesday, Wednesday of this week. And again, that's that fear of lower spending. We love this headline, and I'll tell you why. Saudi Arabia is the outside of the U.S. is the biggest ex-U.S. producer in the world, head of OPEC. If they're slashing long-term capacity out of their oil production profile, that means they're serious about keeping oil production low. That also means you're getting a chance for US producers to increase spending if oil prices rebound as a result, right? If you're taking long-term supply out of the market sniffs that out. And if you get a recovery in demand, which we expect from the US, China, and long-term India, the big 800-pound gorilla there that no one's paying attention to, high prices, who's the one that can most rapidly respond? The US. US service names, their highest margin business, are US stateside producers, right? Because you're not dealing with a government. So we think there'll be more spending in the US, and that's a good thing, not a bad thing for US service producers. So in summary, frugality is your friend. Pay attention to the cheap areas of the market, not because they're cheap, but because they're cheap and they have identifiable catalyst and they can recognize growth going forward in a market that is 21 times earnings led by tech at 25, 26, 30 times and above. That's your friend. Frugality is your friend. Three big things: stock market working off an overbought condition. Like I said, we're focused on those cheap sectors with identifiable catalysts. And lastly, and I think just as important, credit markets remain rock solid. So have a great week. Have a safe week, fun week. And if anyone has any questions, please feel free to reach out at 888-543-3776 or reach out to your advisor. Thank you again and have a great week.